when it comes to making smart investment decisions. Understanding financial ratios is one of the most powerful tools an investor can have. These ratios turn complex financial statements into simple, comparable numbers that reveal a company's true performance, profitability, and risk level. In this video, we'll walk through the top financial ratios every investor should know to evaluate a business effectively and make better investment decisions. Let's start with profitability ratios, which tell you how well a company generates profit from its operations. One of the most important is the net profit margin. This ratio shows how much profit a company keeps from its revenue after all expenses are deducted. A higher net profit margin means the company is more efficient at converting sales into actual profit. Another key ratio is return on equity, or ROE. This measures how effectively a company uses shareholders' money to generate profits. Investors typically look for companies with consistently high ROE, as it indicates strong management performance and efficient use of capital. Similarly, return on assets, or ROA, tells you how well a company uses its assets to generate earnings, giving insight into operational efficiency. Next, we move to liquidity ratios, which assess a company's ability to meet its short-term obligations. The current ratio is one of the most commonly used. It compares current assets to current liabilities, showing whether the company has enough resources to cover its short-term debts. A ratio above 1 generally indicates good liquidity. The quick ratio, also known as the acid test ratio, is a stricter measure because it excludes inventory from current assets. This gives a clearer picture of whether the company can quickly pay off its obligations without relying on selling inventory. Now let's talk about leverage ratios, which help investors understand the level of financial risk a company is taking on. The debt-to-equity ratio is a crucial one. It compares a company's total debt to its shareholders' equity, showing how much of the business is financed by debt versus owners' funds. A high ratio may indicate higher risk, especially during economic downturns. Another useful ratio is the interest coverage ratio, which measures how easily a company can pay interest on its outstanding debt. The higher this ratio, the more comfortable the company is in meeting its interest obligations. Moving on to efficiency ratios, these measure how well a company uses its assets and manages its operations. The asset turnover ratio shows how effectively a company generates revenue from its assets. A higher ratio indicates better efficiency. Inventory turnover is another important metric, especially for retail and manufacturing businesses. It shows how quickly inventory is sold and replaced over a period. Faster turnover generally means strong sales and effective inventory management. Finally, we have valuation ratios, which are essential for deciding whether a stock is overvalued or undervalued. The price-to-earnings ratio, or PE ratio, is one of the most widely used. It compares a company's stock price to its earnings per share, helping investors assess how much they are paying for each dollar of earnings. A high PE might suggest growth expectations, while a low PE could indicate undervaluation or potential issues. Another key ratio is the price-to-book ratio, which compares the market value of a company to its book value. This is particularly useful for asset-heavy industries. Additionally, the dividend yield shows how much income an investor can expect relative to the stock price, making it especially important for income-focused investors. In conclusion, financial ratios are essential tools that help investors cut through the noise and focus on what truly matters. By analyzing profitability, liquidity, leverage, efficiency, and valuation ratios together, you can gain a well-rounded understanding of a company's financial health and make more informed investment decisions. Remember, no single ratio tells the whole story, so always look at a combination of metrics and compare them across time and against industry peers. If you found this helpful, make sure to like, subscribe, and stay tuned for more content that helps you invest smarter.